You go live.
You go for it. Hey.
Hey guys, it's Zasha and Emma, and today we are going to teach you how to become the bank. We'll talk about passively investing by lending money, how to use your retirement accounts to lend, and also we'll make all these boring details kind of fun. We both had experience as borrowers and lenders, and now helping other people do the same. And this is exactly why we added debt to our fund and to leverage our investors' money to also get some short-term returns on top of their long-term returns that they get from our equity deals.
Yeah, so I feel like you had a lot of experience in private lending with your fix and flip business, raising capital from private lenders who would put money in, then you would go and take that money to then do a fix and flip. Where I loaned money to fix and flippers, and I borrowed hard money when I was getting my rentals to fix up my rentals. But I've never actually flipped a house. So I feel like your business and Chris Borden, our partner's business, really was founded on private lending and hard money lending. And I have always done that. It was my very first real estate investment was making a hard money loan as a lender. And it was a great way for me to get into it, a great way for me to learn. It was a great place to start. And that really was what helped me kind of figure out what was going on. And then as I got more into active investing, like buying rentals, buying multifamilies, I've found myself coming back more and more to being a private lender because it's just so passive. It's like the most passive income that you can earn. Um, and there's some pros and cons for being a private lender that I want to share, like why I love it, and why I use it as part of my investing diversification. No one strategy should really be the only thing that you do in investing because diversification is really how you hedge against different kinds of risks. So you're going to want as many of the pros in there and minimizing most of the cons. So, Zasha, can you kind of explain to us what private lending is since you have so much experience with that?
So basically, like Emma had mentioned, it's when you lend your money, if you're a private lender, it could be from your retirement account, it could be from a savings, maybe you're leveraging other types of debt like lines of credit, and you lend that money to another investor to either acquire the property or redevelop it. And they are kind of doing all the work, and you are more of a passive investor. You give your money for that project, but then you also can negotiate the terms, the points, and the timeline. So I feel like the flexibility for on both ends is really key in making it a like smoother transaction. However, if you are lending from your retirement account, there are other stipulations and a little bit more paperwork involved, but definitely a good way to take control and have more control over where your funds are going and what returns you're getting. And you get a steady income through interest payments. You can either negotiate to get those monthly or get paid out at the end. It's secured by the asset itself, which I find a lot of people in find more stability in rather than the stock market or cryptocurrency and those types of things that waver kind of with the market. But in real estate, it's backed by a physical asset. So that really makes a lot of people feel a little bit more secure. You can also put a lien against the property where, say, if you are the in first position, meaning that there's no other lien on the property, you have highest priority. But a lot of times as fix and flippers, we depending on what market we're in, my market is really expensive. So our strategy is to use a hard money lender in the first position who can lend majority of the funds needed, maybe 80%. And then we'll bring on a private lender in second lien position and they'll lend the extra 20% that we need to do the deal. And so the what people look for is prior experience in that investor so that they know, okay, this person has already done deals like this. I am more protected because they have shown that they're able to pull through with these fix and flips. And I'd like to also ask those investors that I'm investing with, what have they done in the bad times or the hard times, and how were they protecting their lenders? So a lot of times they will put the lenders on, say, the homeowner's insurance so that if anything happens to the property while it's under construction or say it burns down, they're protected that way. And there's some other ways that you can mitigate a little bit more of the risk. And so for me, I feel more comfortable lending and borrowing with people that are in my market because they can go to the property, they can drive by, they can kind of feel the shifting of the markets. A lot of times, though, I do raise money through social media, through Instagram, and I've been able to raise about like $7 million through that platform. And you'd be surprised that a lot of more people are comfortable lending out of state. It just depends on the person itself that they're lending to and the trust and rapport that you build with them.
With private lending, for me, it's like diversifying my portfolio. We kind of mentioned this at the beginning. I started out with my very first real estate investing project was private lending. And the reason I felt comfortable with it is because one of my friends was a real estate investor and he was looking to borrow money from us to fix up a house and then put it on the rental market. And he came and sat down with us and kind of explained that it was going to be 6 months and he needed, I don't know, $100,000 or something like that. And he was going to pay us 10% interest. And I remember thinking, even though I knew this guy very, very well, a very close family friend of ours, I just remember thinking like 10%. Wow, that just sounds kind of like a scam. It sounded way too high. And what I've learned since then, that 10% is the going rate, and you could even have a higher rate depending on the risk of the project. 10% is kind of for easy, low risk project. And I also wanted to kind of explain the difference between the points and the interest on the loan itself. And people hear those words and they're like, what does that mean? So interest is just the money that you're making by loaning out the money. We're all familiar with that from our mortgages and things like that. Like you borrow a certain amount of money and then they're going to pay you back that money with interest. 10% interest is really easy to calculate. It's basically, if you lend $100,000 at the end of the term, you're going to get back $110,000. It could be paid out sometimes monthly, or sometimes it accrues during the course of the loan. So the first loan I did, it accrued. And at the end, he just paid me back my original principal plus my full amount. So sometimes you'll see it paid out monthly. We only require people to pay it out monthly if we feel like they're newer or we're a little, for whatever reason. Most of our borrows, we just let them accrue that and they pay us out at the end. Points is a different term. You may have heard of it from your mortgage, where you can buy points or use points to buy down the interest rates. Basically, you're paying extra money to get a lower interest rate or whatever else it is that you're going to pay points for. So origination points, you'll hear them called. It's kind of like a fee for them to process the loan. It's like an extra cost. Or if you're purchasing a house, sometimes it's included in the closing costs. So you may be familiar with the term from your mortgage. It's the same thing in private lending, but what we typically do is we take the loan itself. So let's say it's $1 million loan, and we're going to give them that in portions. Maybe they're going to use some to purchase the home, and then they're going to take out construction draws on the rest of that. As they're doing the project, they're going to get that in little pieces. And so what we want to have those points up front, it's origination points. It's basically a fee for originating the loan, and it's usually 2%. Could be higher, but 2% is pretty standard of the total loan amount is paid in cash up front. And so the way that we do that in our fund, because we have to do something called loan servicing. I mentioned earlier that if they're borrowing a portion of the money and then they're getting construction draws, that's called loan servicing. It's just basically making sure that they're paying their payments, that they're doing the project they say they're going to do. Like we go out there, we'll ask for photos, or we'll do an on-site visit before we will approve a construction draw. So the points are usually to cover the cost of originating the loan, because we got to underwrite it, go and take pictures, do all the financials, just check to make sure that it's a good deal. And then those points are used to actually service the loan. So the way that we do that is our capital that goes in is what's earning interest. And then the points are basically management fees. So that is billed to the borrower to be able to purchase that, to borrow that money from our fund. And then the fund keeps the points as a management fee to both originate and service the loan. And then all of the interest goes towards the capital that is being lent out on that project. And it's a great way to diversify your portfolio because it allows you to have short-term projects. A lot of longer-term projects, it's 3 to 5 year lifespan, but this is usually somewhere in the 6 to 12 month range. Those loans are going to be out, and it allows you to keep your money moving, especially right now where there's a little bit of uncertainty in the property market, especially the commercial property market, for people who want to keep their money moving and they want to be doing better than they're going to do in the stock market, but they really are not ready to commit to a long-term project because they're either not seeing something they like, or maybe they're beginners and they just want to see their money come back, so you can build up some trust and rapport with the people who are servicing or borrowing or whatnot. So for me, it's one thing that we do for cash flow because it's going to pay out sooner than a longer term equity thing. So we really balance the cash flow of the private lending with the upside or the growth that we're going to get with a longer term commitment. So the diversification is really what helps you to balance your portfolio for your needs. How much cash flow do you need versus growth? Do you need the cash now? Are you not retired yet? You could wait for the cash later. So you're really able to customize your own portfolio based on your cash needs.
When I really like this, I wish I would have known more about private lending when I was working my full-time job, because I always thought of real estate investing as having to be active and having to put in all this time. And I was already working 60 to 70 hour weeks as an engineer. So I was already, pretty tired at the end of the workday. So this allows you, like Emma said, just that short-term return, but then also if you are diversified into other multifamily syndications or other projects that are more based on equity, then you can also experience some of those tax benefits as well.
Yeah, for me, part of what makes private lending so attractive is just how passive it is. And if you're the one originating the loan because you want to have your own, sorry about that, you want to have your own lending business, you're going to go out, you're going to find the borrowers, you're going to look at their projects, you're going to go visit their projects, underwrite it. And basically what that means is it's not that passive. It's more like a business. But if you're the lender and you're having somebody else go and vet those deals out and you are just looking at the projects and approving it, there is some upfront work to be able to say, like, yeah, I like this project, I'm going to approve this project, or I want a loan on this project. It's much, much more passive because you're not doing the bulk of the due diligence and you're not doing any of the loan servicing. And so for me, when I'm just putting my money in and I'm not the one actually originating the loan, it's really the most passive income that I have. And so I really love holding private notes is really what it is, whether it's a mortgage or a fix and flip loan or something like that, because I just put the money in and I do almost zero work. And so if you're looking for truly passive income, this really is the key for the least amount of effort put into getting your return.
I agree.
So this slide here, I think it could be considered a little bit in the weeds, but it's important to understand because it's from a risk standpoint. So people are asking, like, is private lending safer or more risky than, say, the stock market or doing an equity investment on, say, like an apartment building? So it's important to understand, like, that the lender is the first person who gets paid. And so you're going to hear first lien, second lien. And so the lower you are in this capital stack, the less risk you're taking on. So the first position would be the senior debt. So on a fix and flip loan, we would be the senior debt holder. And we have to take a lien out on the property. And if they sell it or whatnot, they would have to pay back the money to us first. That means we have the right to foreclose on it. If for whatever reason they're not making their payments, we would actually take the property. And that's one thing that we're very careful about when we're underwriting a loan. It's like, could we take over this project and finish it ourselves or sell it and make good on this loan if we needed to in the worst case scenario? Because we're always having to ask, like, what is the worst thing that could possibly happen, and not like, oh, what's the worst that could happen, right? But actually saying, like, what's the worst that could happen and planning ahead for that. Zasha, do you want to talk about the second position or mezzanine loans?
So in there, really, when you're in second position, like she mentioned, the first position has the lowest risk. You are secured by a note for the second position. However, if you do have to foreclose on the property or someone else has to foreclose on it, the first position gets paid out first, given the name of it. And so it is a little bit lower risk than third, fourth, and last or fifth. But still, there is definitely a mortgage note that gets recorded, and you get paid, like she mentioned, before the profits.
And it's really important to understand when you are a private lender, what part of the capital stack you're in, again, as a risk management. If they're telling you that you're in first position loan, but you actually have another loan ahead of you in the stack, that's really important to know. Because one, if you're on that second position or mezzanine level, you want to make sure that you're earning a higher interest rate because it is a little bit more risky. You want to find out who is ahead of you, how much of that loan they own, and basically like who's getting paid before you. And you want to be paid for that additional layer of risk by getting a higher interest rate. Another thing you want to make sure is that if you're in second position or the loan that you're putting out with the fund is in second position, which we don't really do. We do mostly senior debt. But if we ever do a mezzanine debt, that's more common on a commercial property. You just want to make sure they're not over leveraged. So let's say, for example, what Sasha was mentioning, you take out a loan for 80%. And then the other 20% you're going to bring in on a second position lien. It'd be like more like your friend or your family or somebody from your network who's going to come in that second position. And then is the project 100% leveraged? Because that's going to introduce a new level of risk, especially if those payments are going out monthly, because that person has to come up with that money during the course of the project where the project's not making money. It's maybe vacant. If it's a single family house, it's vacant during the renovations. So does that borrower have enough liquid capital left over to be able to make those monthly payments even before the property is turning a profit? So knowing where you are in that capital stack is really important because knowing the amount of risk you're taking is going to inform like what interest rate you should be asking for, how you want those payments to be structured, how much liquidity they're going to have. And so this type of thing is what we do when we're underwriting a deal, and we'll make sure that you have all of that documentation and disclosures. But some of the things that I hear people running into when they're doing private loans and they're not going through experienced basically lenders like what we do in our fund is they'll think they're in first position, but they're actually in second or even third position and they just didn't know. And so when they went to go collect on the debt, they found out that there was no money left. And so that's the benefit of going with a team that knows what they're doing, that you can really trust, that can underwrite that deal appropriately. And I just also want to make a mention here on the common equity or the preferred equity and the common equity, and then the manager equity. You can see that the managers get paid last. So the people who are basically equity means profit sharing. Like you are business partners, and when profit comes out, you split that profit between you. It also means that you split any losses. And so there is more risk with equity, even though there's usually more upside. There's more risk of downside. And whereas a loan is like you just get paid your monthly payment. If the project doesn't do well, you're not profit sharing. You should get paid even if the project is not successful. They should be able to pay you back out of the proceeds from their own pocket. And so just understanding that equity refers to partnership and profit sharing, and debt really just refers to like, I loaned you money, you need to pay me back. I don't care how the project itself is performing. So understanding where you are and how much upside and downside risk you have is really important in making a decision if you want to do how much you want to have debt in your portfolio versus equity, because you're definitely, most people are going to use a mixture of the two.
One, I like the fact that you mentioned working with a team to do this, because I have started lending as well before getting into the fund, and I really didn't do as much due diligence as we do as a fund. So it was very interesting to see the dynamics, or like, checking for their insurance, making sure that, like you said, we're in the position that they say that we're going to be in, checking their business documents, checking their background, like all of that due diligence is really, really important, especially in this market right now.
Yeah, that's a good point, because we turned down that first offer of a hard money loan because we just didn't know what we were doing. So even though we really trusted the person who was bringing us the deal, it was kind of the first time we were exposed to it. And I just felt like I really trust you, obviously, but I just need to understand more about real estate investing. I need to understand more about how all this works. And so when we ended up making our first loan, it was not the first time we had the opportunity to make the loan because we had to go and learn how this stuff works. That didn't mean that I was suddenly an expert the first time I loaned money. I just came in with a better set of questions to be able to sit down and ask and make sure that I felt more comfortable with it, and I didn't loan out more money than I felt comfortable losing. And so for me, it's not so much like, oh, I trust this person. It's I trust this person, and I did some background to make sure that the deal is good and that the person has a history of paying back the money that they borrow.
Right. Because like you mentioned too, you have to make sure that if you do have to take over the property or foreclose for any reason, that you're able to now take on this new project, right? Because you are still leveraging and securing it by that asset. So the asset has to make sense in the end.
Yeah. And that's why for me, it's easier to invest through a fund, a debt fund, because we, as the loan servicers, are the ones who would be taking over the project. And when the first time I made a loan, like if he hadn't paid me back and he had actually defaulted on that loan, could I have taken over that house and finished the flip myself? Like, probably not. So I feel like getting yourself into a situation when you're not able to take over the project means that you should probably be working with somebody who knows how to underwrite that and who is capable of servicing that loan or taking over the project in the worst case scenario. And if that's not you, then sometimes investing through a fund is really the best call, and make sure that people who are managing it, so like Rise Capital, knows what we're doing, we know how to do the underwriting and all of that, rather than saying, oh, I have money, I can just go loan it out myself. That's a business. So are you looking for a passive investment, or are you looking for a business? And there's no right or wrong answer to that. You just have to ask yourself, like, what's the best path for you, if you're going to be doing private lending through a fund as just a lender, or doing it as a business, as a person who's servicing and underwriting the loan. All right. Let's go over our target terms that we use in our fund. Time frame, short term, 6 to 12 months is pretty typical on residential. If we're going to be doing a commercial property, it's usually a little bit longer, 12 to 24, and sometimes that will be in the second debt position. A small commercial, we may be in a senior debt, but if it's a larger commercial, we would usually come in as a second tier mezzanine debt. And again, it just should be a higher interest rate. You should really know that the person who's borrowing is not over leveraged, and that they have a history of making timely payments and making good on the loans that they have. So again, we kind of covered the debt position. Everything we've done thus far has been first position. We may occasionally offer a second position. And the nice thing about the way that Rise Capital works is when you log into the portal, you'll see the deals that you're investing. It's not like, oh, I'll put money in and we make those decisions on what we're going to invest. Like, you actually get to look at every single deal and opt in or opt out, a la carte style. Sasha?
So typically the return on the capital, we see cash on cash is between 10 to 12%. Now that may waver depending on the deal, but that's typically what the offer is, and it's paid in full at the loan maturity. Like she mentioned, there are some deals where you do get paid out monthly interest payments, but for majority of the deals, you get paid out at the end, the same time the investor gets paid out. And then, of course, with all the deals, it's not good to be fully leveraged, not 100% leverage. Well, depending on that person's experience or your relationship with them, and obviously their results, and the deal. So typically we'll lend between 70 to 75% to make sure they have skin in the game, whether that's their own money or they raise, private money for that difference. And then also the 80% loan to cost for residential. So commercial about 70 to 75%, and then about 80% for typical homes.
So let's talk a little bit about our background and history as lenders and borrowers, because I've worked with a lot of potential real estate investors who have some capital. Maybe they sold a house, they sold a business, they received an inheritance. For whatever reason, they have a chunk of cash, and they're like, I want to do private lending, and it has all sorts of different names, like Gator lending, private debt, hard money loans, whatever it is that you're calling it. It's basically the same thing. Like, it's not through an institution or a bank, it's through private individuals. It's like peer-to-peer lending is another term you're going to hear a lot. So Chris Borden, our CEO, he really built his first real estate business on hard money lending. He had some of his own capital to lend. The regulations are much different when it's your own capital versus when you're raising capital from other people. So he was lending out his own money for a while to kind of figure out how it all worked, and really built up his business on the basis of making those loans, underwriting those loans. His wife, Harmony, is a realtor, and so they have good access to data to help them figure out, like, is this project really worth what they say it's going to be worth after they fix it up? And then they're experiencing running businesses in the background. So that was really where he was coming in to Rise Capital with his core competency. And me, even though I did private money as a lender, and I also borrowed private money, I did hard money loans when I was buying a new rental. But we also would use hard money or private loans on our apartment complexes. So we'd buy an apartment complex, And we ourselves in a joint venture would put our own capital in to say it was an 80% loan. There was no construction money. And so then we would raise private loans from just friends and family or just people we knew from our network who would put notes so that we could do our construction. So we have borrowed many times on both residential and commercial properties as lenders, but my core competency really is more on the commercial side and operations and renovations on apartment buildings specifically. We do have some warehouse and storage experience as well, and now we have our RV park. So that was where Chris and I basically joined forces to say, like, I've got the commercial projects that need the lending. You've got the lending background from a business standpoint. Like I said, as a borrower and a lender, it didn't mean I was running a business doing this as like my main income source the way Chris was. And then Zasha, could you share a little bit also, because you came in more on the private lending side as well, and so that experience coming into Rise Capital was really I feel like really supplemented and enhanced where I was coming in to the business as well.
Yeah, and I think being an active investor, doing fix and flips from single family, multifamily, and then diving into commercial renovations as well, it really was a turning point for my business. Was leveraging private funds and private lending because the terms were semi-negotiable. There's easier and flexibility with receiving the money or getting the construction draws out as well, and that was really important for me to be able to bring to the fund, was just that experience of being raising a lot of money that way, and then knowing what potential investors were looking for out of the debt side of things as well.
And we do have there are 7 of us in the Rise Capital leadership team, and what that's going to give you is just a level of organization behind the scenes to make sure that we're all specializing in our particular areas, to make sure that like the portal's working the way that it's supposed to, that your taxes, your K1 statements are getting delivered on time, that if you have a question, somebody's there to pick up the phone or answer an email. And so it allows you to have access to a large team. We're not just doing this from our kitchen tables, so to speak. Like, we are a team doing this as our full-time pursuit with both debt lending in our fund, and then when we find a great partnership or equity deal, bringing that out to you as well. And you can keep your money working both short and long term for that diversification. So you want to meet the other members of the team as well, and get to know all of us, because we definitely are all full partners working together on this project. Zasha, do you want to just mention briefly what makes our group a little bit different than other groups that they might have the opportunity to invest with?
First off, I would like to say that we definitely are different than other investors who are just looking for profits. We also want to make sure that we are making a positive impact while also building wealth for ourselves and our investors as well. We have several of us on the team who are working on affordable housing, and we want to basically meet that social need of contributing and not adding to certain issues as far as different communities that have a shortage. And it's, especially here in Hawaii, it's a very limited market as far as housing is concerned. And because we are mostly majority and female led, we have a strong representation of the diversity in our group. And we're also definitely mindful of the environment. And I think Emma, just even for her, just inspiring how she has changed her life, and just more recently living the passive investing journey of quitting her job, just living off her passive income, being able to travel with her family. That's really what we want for our investors, to be able to have their money working for them, have it moving, but then also being able to enjoy it, right? Enjoy the fruits of their labor now, instead of waiting until you're 65 or 67 or 70. And so that more so is like the emotional part of it, and why we care so much about our investors and what we invest in. But also, we are very experienced in different areas, such as Chris is a CEO and of a C-suite, and we have many different backgrounds, me being an engineer, Emma working in multifamily for years now and have led successful groups who have then become their own leaders in their spaces. And so I think it's important for us to have these principles and core values in place while we're investing, and not, of course, everyone wants to make money in the end, but how we make money definitely matters to us.
And it matters to us what we do with the profits that we make ourselves and share with our investors. We're really looking to partner up with people who want to make an impact in their local communities. They say things like, I never want to retire, but that by saying that, they don't mean I want to work in my cubicle until I'm 65 at my 9 to 5. They're saying I never want to retire because I want to achieve financial freedom and then move on to doing really meaningful work. And Chris and his family right now are actually in West Africa working with their nonprofit organization, empowering the virtual assistants that we use. Basically started that through a nonprofit to help people who have education and experience to be able to find work, even if they're living in an area, developing area that doesn't have a lot of economic opportunity. And so it's like the first thing he did when he retired was start a nonprofit and start volunteering. And so those are the kind of people that we like to work with. And as Sasha mentioned, mostly like minority and female led gives us a different kind of perspective when we're making investing decisions on how we can most impact our investors. And then you can go out and impact your own communities. That's very important to us. All right. The next step is, people always ask, like, what's next? So jump onto our website. If you want to book a call with us, go to partnerwithrise.com and you can get it on our calendar, or go to risecapitalinvestments.co and jump on there and click on investor login, and it'll take you to our private portal. So once you've created the login and a password for that, you can actually go in and see the deals that we're offering. We used to have a deal come up every month or so. And so you're able to feed capital in almost like a rotating basis, and so that you're able to kind of do it one deal at a time, and instead of having to save up and save up and save up so you have enough to be able to figure out where you're going to put it, you can have money coming in kind of as time goes on, as deals come up in the portal. So you can jump on the portal, check that out, select your investment, all the instructions you need on there to be able to fill out the paperwork, wire the money. And like I said, call us anytime. Raquel and Troy and I will help just walk you through how to get into that portal, how to use it. And then obviously the best part is the relax and enjoy, to be able to track your portfolio through that master dashboard, to be able to see all the investments that you have with us, how they're performing, when the tax forms are going to be in, just kind of keeping an eye on everything there all in one place. And so that you don't have to be hunting around and figuring out like what's going on. So you're able to just kind of sit back and enjoy. And when you have more capital to invest, you just jump on the portal and put that in there. And it just makes it really easy for you to be able to kind of like one time sign documents. And then after that, just have that management working through that portal.
And I believe we do have some investments that they can invest in now, right?
Yeah, I think we just closed one. I didn't even think we got to bring that one out to the community because like the first two people who logged in funded it. So just make sure you kind of keep an eye on things as they're coming through, so that you make sure you get in on those opportunities, and we'll be bringing out more and more of those. So if there's not anything on the portal at the time that you're looking, like, just let us know, and keep checking back, and we'll be sending you emails or even phone calls when we have something come up, because they do fill up somewhat quickly, especially the private debt. Those ones tend to go pretty fast.
Yeah. And those are faster turnarounds too, as we kind of need to give them an answer right away.
Yeah, exactly. They're like, hey, I've got a house, I'm closing it next week. Can you guys fund? And so we really need to make sure that those debt deals are moving pretty quickly. And that's the benefit of having short-term investments in the fund. So just want to make sure, Sasha, is there anything that, like, what are the frequently asked questions? Is there anything we didn't cover when you're talking to lenders?
I think as far as the debt, I mean, the one concern a lot of people have is like, okay, how quickly am I going to get my money back? Especially for short term, if they're already investing in long term. So we covered that, the average 6 to 12 months, depending. Sometimes for the fix and flip projects, as you probably experienced as well, you may need to extend, but for majority of the part, it's that kind of time frame. And I think one thing to point out too is that we will be attending. Are you going to be attending Best Ever Conference?
I'll be in Salt Lake City. We're having an event on April 9th at Legends in downtown Salt Lake City. So if you're going to be in town for the Best Ever Conference, be sure to check out the Rise Capital event at Legends. I'll be there. My husband will be there. We're actually driving in. The eclipse is on the 8th at our RV park, and we're basically leaving as soon as the eclipse is over to drive to Salt Lake City and hang out there for the week of Best Ever. So we would love to see if you can come out to that event. Just let us know and we'll give you the exact address and location so you can join us there. And we're going to be having a couple of speakers, some VIPs there, maybe some snacks, and just be able to network with the people who are all coming into Salt Lake City for the conference. We'd love to see you if you're going to be in town.
Yeah, I love that conference. Is that I feel like that's the biggest kind of commercial real estate conference where you have passive and active investors.
What do they have, like 3,000-ish?
Yeah.
Like right around 3,000? Mm-hmm. Yeah. And a lot of passive investors are coming as well as active investors. So I'm really excited about it. We're going to be able to just meet a lot of people and just you get a lot of networking out of the way so you can start those relationships because they're so important that you trust and know the people that you're investing with. And most of our investors to this point, not all, but most of them, one person on the team has met them in person at some point. It really does help to build a relationship of trust so that we kind of get a feel for each other. That gut check, you cannot underestimate the power of the gut check when you're making investing decisions.
Amen. Okay. Well, thank you guys all for attending. We hope you got a lot of value. We actually will be doing a deeper dive, I believe next week on a webinar on debt. So we'll post the link below or look out for the link in our events, our LinkedIn events. And please contact us if you're interested in investing in our fund or getting to know our team a little bit more. Partner with rise.com, and we would love to help you grow your wealth.
Yep, just jump over onto risecapitalinvestments.co/webinar to sign up. We do a LinkedIn Live every Thursday at Lunch and Learn. And every other Thursday, rather. So one in the afternoon, and then the following week will be in the evening as more of a webinar format. And so we're definitely going to take a deeper dive into this, take your questions if you want to join us next Thursday. Thanks, everybody, for coming.
Aloha.